Is Apple still a good investment, or it will fall like the rest of the big tech stocks? Let's deep dive into Apple's business results, review their upcoming announcements, products, and analyze what the potential future return we could get from the company. As always said with educational purposes and is not meant as financial advice. Apple is the only big tech company which still has not fallen drastically from its all-time high. Today, Apple is worth more than Facebook, Amazon, Google, and Netflix combined. All of these companies have fallen by about 30+ to about 75+% from their highs. According to Apple's Q4 results, ending in late September, the company posted a record revenue of $90.1 billion, up 8% year over year. The revenue breakdown comes from two categories: products and services. The revenue from products mainly comes from the iPhone, the Mac, AirPods, the iPad, and Apple Watch. This segment has provided Apple with about $70.9 billion during the latest quarter, while the services revenue includes Apple Music, Apple News Plus, iCloud, Apple TV Plus, Apple Arcade, and Apple Fitness, which have earned the company a combined $19.1 billion during the quarter, up from about $18 billion in the year prior. Also, the company grew to reach 860 million paid subscribers on its platform, which is up from 825 million it reported in its previous quarter. This figure is up more than 160 million in the last 12 months alone. The App Store is very important for the company as it takes 15 to 30% share of the sales done through it. Also, a new driving force for upcoming growth in sales will be the Apple App Store ads that are implemented with the new policy changes, which have also hit Meta quite hard. It is interesting and helpful to make an even more comprehensive breakdown of the revenue, so let's do it. Out of the 90 billion in revenue, 42.6 billion comes from iPhone sales, 11.5 billion came from the Mac, 7.1 billion came from the iPad, and 9.6 billion came from wearables and home devices, such as the HomePod, which is a competitor to Alexa. The other 19 billion, as I mentioned, come from services. As the iPhone is the top revenue driver of the company, it is important to understand what the global market dominance is in the smartphone sector. For this, the best info comes from the Analysys website and their quarter-to-quarter breakdown of the market. Over the past 1 year, the global smartphone market has shrunk by 8%, which is a third consecutive quarter of decline. This is due to a global economic contraction and lack of spending. While here we can see the global market share of each major smartphone brand and how it has changed over the last 1 year. Apple now has an 18% share of the market compared to a 15% share 1 year ago. The market leader is Samsung with a 22% share. What we could see is that Apple is the only one with a slight change in the market share and has taken the dominance from smaller phone manufacturers coming out of China. Now that we have examined the top line of the company, which stands for the revenue, let's take a look at the bottom line, or the net income in other words. The net income of the company is up by 5.7% year over year for this quarter, and for this quarter it stands at $20.7 billion. Over the last 12 months, the net income is $99.8 billion, which is up compared to the previous 12 months when the income was $94.68 billion. A major reason for Apple's strong performance in relation to other big tech companies is the consistent growth. Yes, the growth is not enormous, but it is much better than lack of growth or negative growth, which is seen in other big tech giants. What I do not like in the company though is the current high multiple given to its earnings. The current PE of Apple is 23.5 During late 2020, when the market was at its peak euphoria moment, the PE ratio was more than 35. What one of the greats of the investing world, Peter Lynch, says, the PE of a company should not be more than the growth rate of the revenue when talking about PEs of 20 or more. This means that if we buy a company with a PE ratio of 25 to 30 or more, we want the revenue growth over the past several years and the following years to come on average to be around the same as the PE. So the growth rate should be from 20 to 30% if we buy a company with a PE of 25 to 30. In the case of Apple, their growth rate is expected to be in the lower single digits for the upcoming years, which indicates that the current PE is quite high. Also, a way to analyze whether the PE is high or low is to take a look at how it changed over the last several years. For this, we take a look at a chart provided via macro trends. Now we are at a historic highs, which means that the positive sentiment has never been so positive for the company. And normally in the investing world, big profits are made when we buy up companies when everybody is fearful, and most of the time losses are made when people buy the positive sentiment. Apple stock is the largest part of Warren Buffett's portfolio, sitting at about 40%, but when Warren Buffett was heavily buying Apple in 2016, the PE was around 10. This means that from then until now, people are willing to give the company more than twice the multiple on its earnings, and the higher this multiple goes, the lower our future returns will be. Also important to mention is the law of large numbers, which states the bigger the company gets, the slower the future growth will be, since it is easier to turn $1, for example, into $2 than turning $100 into $200. So from this perspective, I personally think that Apple has some room to fall. And also, it is important to note that as Carl Icahn, Peter Lynch, Buffett and many other greats say, there are incredible companies which are bad investments due to their current prices. I think that at these levels, Apple is an okay investment, but definitely not a great one. And if we want a higher return, we must wait for the company's stock price to fall lower. When examining the debt levels of the company, it also has some room for improvement. Its short-term liquidity is not great as the current assets are 135 billion, while the current liabilities are 153 billion. This gives us a current ratio of 0.88, and it is best for this to be above 1. Which will indicate that the current assets are higher than the current liabilities. Current means they are due over the next 1 year, and this metric shows the short-term debt health of a company. For example, Facebook and Google have multiple times better debt ratios on all fronts. Make sure to watch my analysis on both of these companies, as you'll be provided with great value. The cash and cash equivalents of Apple are around 48 billion. For example, Google has 116 billion in cash, while Facebook, or now called Meta, has 42 billion. And both companies are significantly smaller in market caps than Apple. The current earnings yield of Apple is about 4.25%, and we find this when we divide the current PE of 23.5 by 100. On top of this, we can put the future growth perspective in Apple's earnings, which according to analysts on average are going to be between 5 to 8% in the upcoming years. With this, we get a potential return of between 9 to 12%, which is expected and not certain. So if the economy contracts even more, which is very likely, the growth of Apple, just like the other big tech companies, can be negative. In the case of Facebook stock, for example, we can get this potential return even if the company does not grow at all, and this is due to its current low valuation. In the investing world, we must always be conservative, as this conservativeness is what protects us from losses. If we're always positive, sooner or later, the market will slaughter us like a pig. And yes, this is a famous investing phrase. But to end on a good note, Apple has a lot of new products in its pipeline over the next several years. After the release of the 24-inch iMac, rumors say Apple is now working on a larger iMac expected to have a display size ranging from 27 to 32 inches with a mini LED display. Also, in the upcoming years, Apple will release its AR/VR headset, which could possibly be a winning product. It is important to note it could, not it will be. Another major product which has been in the works for close to a decade is the Apple Car, which is expected to come to market by 2025. The EV sector is booming, and this will be one of the most important products Apple has ever launched, and it will be a true turning point in the company's future. In general, Apple is a solid company, but not a solid investment in my opinion. Yes, it has the most stable current business growth out of all big tech companies, but this most likely will change as the economy starts to contract on a global basis. The past indicates that Apple can go much lower when looking at its current valuation, and this will open a much better buying opportunity. I'll keep an eye on Apple, so make sure you keep an eye on the channel. With this, I end the video. Subscribe for more if you have enjoyed these stock analysis, and hit the notification bell so you don't miss out next time when I post a stock analysis video. Leave me a comment down below which other stocks you want me to cover next. Goodbye for now, and until next time.